join Madakil. Yeah, I hope everybody's joined. Yes, so let's continue. I was saying approaches of working capital management. Here you have aggressive, conservative, and moderate. Clear, all of you? Yes. Now, approaches again for investing, you have financing, you have different approaches. Always remember, whenever approaches come, you need to give a note about PLS, right? Profitability, liquidity, and solvency. Working capital is basically balancing these three approaches, balancing profitability with liquidity and solvency. If you try to increase profitability, there's a chance that you might impact your liquidity and solvency. If you try to improve your liquidity and solvency, you'll have a adverse impact on profit. Understood? This is my basic concept. Now let us understand what is aggressive, moderate, and conservative. Aggressive policy, very aggressive. You know that everything you can do, huh? That attitude. Anything possible, I'll do. Yes, that is aggressive, but make or break. Yes or no? So in this case, you'll have very high profitability. Understood? Because what you do, you try to keep your inventory is less. Yes, right. So that your investment block is less, interest cost is less, profitability is high. But it could also lead to issues later because you have low liquidity. Understood? Then comes conservative. Boss, I want to be safe. Very high inventory I keep. Nothing should get hampered. But if you keep very high inventory, what will happen? Liquidity solvency will be good, but will have an impact on profitability because cost of the investment block will be more because of its interest cost will be high, and therefore profitability will be low. Is it clear? That is conservative. Moderate is a balance between the two. When it comes to financing, it's about long-term debt or short-term debt. Understood? Always remember, here you will get confused. Think from the banker's perspective. What is less risky for him? Short-term debt is less risky for the banker. Therefore, for short-term, the interest will be lower when compared to long-term debt. Yes. So if you're going for aggressive, you want profitability to be improved. Aggressive means profitable, high profitability. Short-term objective is right. So you'll go for, if your profitability should be good, you'll go for short-term debt. Understood? But it'll have an impact on liquidity and solvency. Whereas moderate is the conservative is the other way around. You want to ensure that you're safe. Profitability, it's okay when it's high. Therefore, go for long-term. A combination of long-term and short-term is your mid-term moderate policy. That is somewhere in between. Next comes your operating cycle. R plus W plus F plus your debtors plus minus creditors. So R plus W plus F plus D minus C. Raw material holding period, WIP holding period, finished goods holding period, plus the debtors holding period minus creditors holding period is your operating cycle. Is it clear? Right? Then estimation of working capital. You need to estimate what is the raw material, what is the WIP, etc. Here, please remember your cost sheet knowledge is important. Go through the problem that I've done in the class. Here, raw materials, estimated production units into estimated cost per unit, raw material cost per unit into average raw material holding period. Then comes WIP. Here, estimated WIP cost per unit until the stage of production. Yes. Then cost of production per unit. For finished goods, you'll use COP. But for debtors, you'll use cost of sales, very important. Only here you will be considering cost for sales. Right? For debtors, this is the only formula where you consider cost. Is it clear? For estimating the working capital, estimation of working capital, in that the debtors value you will consider cost. And that too, most of the place we consider cash cost. Cash cost, that means depreciation also will be excluded. Clear? Yes. All right. So again, trade payables, direct wages, and overheads, whatever the estimation into the time lag, will get the answer. Here, estimation of working capital, current assets, current liabilities, you will subtract, add safety margin. If it's given in the question, then you get the estimated net working capital. Cash management models, Bauman's EOQ model, very similar to your material EOQ model. Here you have, please go by what we have learned in the class. Yes, there it is square root of 2AB by C, annual demand of input. Here total cash demand. Understood? All of you. Then there it is ordering cost per order. Here you have your transaction cost per transaction, right? Financial transaction cost. Clear? So total cash demand, financial transaction cost per transaction divided by there it is carrying cost. Here your opportunity cost. Is it clear? Same thing, Bowman's model. Then you have Miller-Orr model. Here you have two limits, one upper limit, one lower limit, and then return point, three limits. So cash keeps fluctuating. When it reaches the upper limit, you invest, get it down to the return point. Then again, cash will keep fluctuating. When it comes to the lower limit, you will sell your investment and get it back to the return point. This is nothing but Miller-Orr model. Is it clear? Right? Then you have your payables management. Please understand, nothing is free of cost. Even payables, there is a hidden cost involved. Why? If you pay up in 2 days or 3 days, etc., they would have given cash discount, right? So if you remember 2 bar net, 2 bar 10 net 40 example, right? 2 is the purchase, cash discount you get if it is paid within 10 days. However, net 45 days is the credit period. Understood? Sir, how do I decide which is better? Do a cost benefit analysis. Very simple. Incremental cost, right? If you avail the cash discount, if you avail the cash discount, your return is your cash discount. Yes or no? However, what you have to incur, you need to incur additional opportunity cost because you're paying cash upfront. So there will be certain opportunity cost until the last 45th day. That cost you need to compare it with the 2% that you're saving and see which is more beneficial. Clear all of you? Yes. Then comes your cash budget, where cash budget only certain important things is opening cash of the first period will become opening of the total. Closing cash pragna of the last period will become closing of the total of say 4 periods or 3 periods, whatever it is. Understood? Yes. Then loan. Whenever it is going negative, normally it is assumed that you are going for a loan. Clear? Loans are normally repaid whenever there is surplus cash available. Yes, in such cash management problem, they would have given you that the interest will be repaid only at the end. Is it understood, all of you? Next, another important point in cash budget, they would have given you what is the sales, right? Credit period is 30 days, 60 days, etc. 50% received in current month, 50% received next month, all those things will be given, say for purchases and all. So accordingly, you need to do that zigzag, right? So we mark it. December received 50% received now. November 30% received now. Adana map manbit we do it. Understood? Yes. Okay. Finally, last two chapters, investment decisions and dividend decisions. Investment decision, right? Capital is also called my capital budgeting. Here, most important is estimation of the project cash flows. But before that, first you have to ensure selection of a project. It should be in line with the objective of the company. Only if it is in line with the long-term objective will you even go for evaluation. Otherwise, you will not even go for evaluation. Clear? If it is in line, then you will go for evaluation. Is it clear? Now, when you are evaluating, obviously you will apply the capital budgeting techniques to evaluate, and then you will see finally whether it is acceptable or not. Understood? That is in brief, the entire capital budgeting process. There are a lot of decisions here. First one, based on the firm's existence, you have replacement and modernization decisions. For replacement, normally go for incremental approach, what is done in the class, expansion and diversification. Next comes mutually exclusive decision, either this or that. Accept or reject, that is one project could have been given, either you accept or reject it. Contingent decisions, if it is contingent based on certain criteria, that is called contingent decisions. The project cash flows, there are three categories. First one, initial cash flow. Yes, all of you sit straight. Initial cash flow, then comes operating cash flows, and then terminal cash flows. Clear? My initial investment or initial cash flow is basically investment in fixed assets. It also could be working capital. Now, if fixed asset is purchased at the, say, not in T0, but at T3, even then show it in the first table. Remember X, Y, and Z. X is my initial investment, Y is operating cash flow, Z is terminal cash flow. In X itself, you show all the cash flows which will not come in P&L. Very simple. All balance sheet items will come in X. X is normally cash outflow or net cash outflow. Clear all of you? Say in case of replacement decision, it could be a net cash outflow in X. Clear all of you? Z is always cash inflow, terminal cash flow. It could be your salvage value of fixed assets. If nothing is mentioned in the question, working capital is assumed to be released at the end of the project. So that will become a terminal cash flow. Is it clear? Then operating cash flows we have. Is it understood? Right? Operating cash flows is basically your, profit and loss. But however, you have to consider CPAT, cash flow after tax. Clear? So do the normal computation minus tax. Arrive at the profit after tax. To this add back depreciation, that is CPAT. Interest is not considered in your CFAT computation because of exclusion of financing cost principle. Since in your CFAT, you are already discounting on a time value of money, you will discount. So in that discounting factor, interest cost is already included. You should not include it again. Therefore, interest is excluded. Understood? So this is in essence your investment decision. Most important is these things. Next, I'm focusing more on the problem than on the theory. We'll glance to the theory. Problem, very important. Tax is always calculated on accrual basis until and unless specifically within the question it's cash basis. So you do the normal preparation on accrual basis, compute the tax. Now, if there are some payments that are being done in advance, etc., for that you need to give an impact again. So above the profit after tax, you would have considered based on accrual basis because tax is computed on accrual basis. After that, you will add back this cost on accrual basis and subtract the cost based on cash basis. Understood? This is an important adjustment that comes in the examination. Clear? Then comes your, say, unequal lives. If it is unequal lives, what do? We take the equivalent approach. Yes or no? So you calculate the cash flows in normal. No. Then you divide by your present value annuity factor, PVAF, to arrive at what is the equated annual cost. Understood? Then you have replacement chain method, LCM approach. And with problems as such, I don't expect in the examination because it's not there in study material also. However, you know how to solve the problem. But what is important for both approaches is that it is assumed that the projects are repeatable. Adike one problem we had done wherein either it was purchasing a new scooter, I think, and then or purchasing 2 second-hand scooters over the same lifespan. Clear all of you? Yes. All right. Then you have your block concept. So, income tax, we already learned how the block concept as you approach. That is very important here also. Until and unless even a single asset is there in the block, then capital gain computation asset doesn't come into picture. You need to just continue with the block. Clear? Even if there is one asset. Yes? All of you understood? Yes.
Yes, sir.
Okay. Then comes your capital budgeting techniques. Am I audible?
Yes, sir, audible.
Yes. So then comes your capital budgeting techniques. Net present value is what? Present value of the cash inflows minus present value of cash outflows. That is my net present value. Then comes your profitability index, wherein net present value of the cash inflow divided by present value of cash outflow. Net profitability index, that is your net present value divided by present value of cash. Clear all of you? Basically, PI minus 1 is nothing but NPI. Yes. Then comes payback period. That is the period in which the investment would be paid back. Clear? Then comes discounted payback period, where you consider the time value of money. Understood? Then you have your accounting rate of return. That is, you take the book profits and not your cash flow. That is accounting rate of return. Yes, everybody? So then comes IRR, internal rate of return, wherein the present value of cash inflow is equal to present value of cash outflow. That is at IRR, NPV is equal to 0. Yes. Then comes modified internal rate of return. Why in IRR it's an aggressive assumption that all the intermittent cash flows are reinvested at my IRR. Here it is assumed that it is reinvested at another rate. Normally it could be my cost of capital. Take all the cash flows to the last year and then discount it to the current year. That discount rate which equals it to my present value of cash outflow is nothing but MIRR. Clear all of you? So this is the summary of investment decisions. We'll just go through your material once and then we'll discuss dividend decisions. Yes. So I told you capital budgeting techniques. We discussed all of them. Right? Payback period when there is uniform cash flows right? So total investment divided by my annuity, whatever I'm getting, that is my payback period. Accounting rate of return, I told you have to consider the book profits. Then the decision criteria, right? NPV is greater than 0, you accept. PI is greater than 1, you accept. Internal rate of return, if it is more than KO, you accept, or expected rate of return. Yes. Last, dividend decisions. Yes. Here also, what's the most important decision? How much should be retained? How much should be distributed? That is the thing, but your dividend decisions. Yes. Hilly. G is equals to BR, where B is the retention rate, R is the rate of return. Right? When you multiply this, you get G. Here you have two theories. Again, relevance and irrelevance. Relevance, you have Walter's model and Gordon's model. Irrelevance, you have Modigliani-Miller model. These three are the most important when it comes to dividend decisions. Walter's model, okay, let me screen share. Yes. So Walter's model, P is equals to D plus R by K into E minus T divided by whole divided by K. Yes. When R is, this is same for Walter also, okay, and Gordon also. When R is greater than KE, right? Don't pay any dividend. When R is equal to KE, anything is okay. When R is less than KE, pay everything. Yes, distribute everything. Gordon's model, it's very similar to what we already learned in KE, yes or no? So E into 1 minus B is nothing but D1. Okay, dividend by KE minus G. Clear all of you? There it was D1 divided by P0 plus G. Here it is D1 divided by KE minus G. Is it clear? Right? Then Modigliani-Miller approach. P0 is equal to P1 plus D1 divided by 1 plus KE. N P0 is equals to P1. Right? What is given. P1 into N plus M. We use the formula M minus I plus E whole divided by 1 plus KE. Is it clear? Right? Number of shares required is number of shares to be issued for raise of fund. That is M. M is equals to funds required by price. Funds required is I minus E minus ND1. Basically, this is my retained earnings. I minus retained earnings divided by P1 will give me additional shares to be issued. Traditional method, that is Graham and Dodd model, wherein a bird in hand is better than two in the bush. Dividend should be given more weightage than your earnings. So M multiplier into D plus E by 3. Lintner's model focuses on consistent dividends to be paid, stable dividend, right? There should not be huge fluctuation, because of which D1 is equal to D0 plus EPS into target payout ratio minus D0 into adjustment factor. Yes. So then there is the MTP analysis, important areas, right? So MCQs and descriptive, we know this. What is the question paper pattern being asked now? 15 marks MCQs, then 35 marks descriptive. Last question only in your descriptive, again you'll have one more choice question, 2 or 2 anta. Okay, here 15 marks is question 1, 10 marks each for question 2 and 3. Case study question, normally one case study of 10 marks will be get, sometimes even 4 mark, another case study and then one independent question, or sometimes another 3 independent questions also can be asked. Okay, the important problems, go through it, already discussed. Yes, then I'll come to the order of the attempting. That is extremely important, because that is where all of you are losing marks. You're attempting for 80 marks, 85. Many of them. Yes. So 2 to 210, scribble in the last page, important points. Firstly, you should do the elimination of questions. First 15 minutes, please eliminate. Understand which question you're eliminating in FM as well as SM. Keep your order of questions as much as possible ready. Which will be the order in which you will attempt. Right? Scribble something in the last page, make important points. Then attempt the first best well-known question. Okay. Then second question and then last question. Finish off FM descriptive. Then come to MCQ. SM MCQ will take lesser time. FM will take more time. Here only I am worried. Do not spill over. Try to finish your. So keep a time limit for FM MCQ. Right? So here it is distributed 1.5 and 1.5. Okay. But MCQ FM, what will happen? You spend more time than SM. Anganta, do not ignore SM. Please, SM only, that MCQ you can score out of out, because conceptually, if you're clear, easy to mark the answer. Understood all of you? Yes. At no cost, including MCQ plus your descriptive. Ideally, it should be 1.5 hour, 1.5 hour. Maximum you can exchange 15 minutes, not beyond that for FM. Is it clear? 1.5 should be your ideal time. Right? So you know the timeline that is given. That is until 3:15 you do that is 1 hour 15 minutes side. Right? So we have kept some more time for FM. But don't go beyond 1 hour 45 for FM. Beyond. At least I'm telling minimum 1 hour 15 minutes you need to give SF. Minimum. That's not maximum, minimum. I'm happy if you can do 1.5, 1.5. Maximum extend 15 minutes because it is not worth writing 2 hours of FM and 1 hour of SM if you compromise on SM quality and you lose marks there. Clear. I'll understand ultimately it is 50 mark paper for FM and 50 mark for SM. Don't treat it like 70-30 or 80-20. That's what you guys are doing nowadays. Be careful. Okay. Keep an eye on the watch. Plan your paper well. And FML, if you go get stuck somewhere, please, you're not one perfectionist. It's okay. Okay. In the examination, don't try to be perfectionist. That's not important. As long as your evaluator can understand your answer, that's more than enough. Your legibility is there, that is enough. Okay? Yes. So all the best to all of you. Rock the exams. Right? We'll have all the fun later, but now study. Keep the same pace, maintain the same pace. Do not slack. Do not slack. But yes, like sir told, don't overdo also. Keep the same pace what you've been doing so far. Okay. All the best, everyone. Bye.
Thank you, sir.
Thank you,
Thank you,
sir.
sir.
Bye, sir.
Bye, sir.